Okay, so in chapter 6, we actually did kind of get close to the financial operations side of things, at least on the investment and reinsurance side. But we're going to focus more here when we talk about operations is on the underwriting and profit side of things. Okay, so the underwriting and profit. We'll spend most of our time talking about property casualty loss ratios, combined ratios, underwriting ratios. Okay. And then we'll move, a little bit to life and health insurance assessments. Okay, so how strong are they financially? How well are they doing? So this is mostly kind of straightforward accounting, okay, for insurers and looking at how they operate on the kind of line item basis that we would see. Okay, all right. So if we were to take a cross section of balance sheet, look at assets, liabilities, and equity for a property casualty insurance company, what would be different about that compared to, let's say, a bank or any other financial institution? Okay. So I give you a brief definition here. There's no real accounting requirements coming into this, class, but a brief definition here. Okay. But most of the assets an insurance company holds are going to be on the investment side of things. And this is true for life and health as well, but property casualty too. What are we doing with those premium dollars that we have now earned? Well, we're investing. Liabilities. Okay. These are new for you guys, and you wouldn't see anyone other than insurer really focus as much on these. First, loss reserves. So because we know from chapter 6 that the cost of this product is not known until after the fact, and sometimes even farther after that, because you can have these losses that are covered in the policy period, but you're paying for them after the policy period because it happened during the policy period. But because we know there's a lot of uncertainty, property casualty insurers, they actually hold on their accounts, on their books as liabilities, estimation for these losses, call them loss reserves. Now there are a number of different types, ways we can look at loss reserves. Be losses that have already happened, we've incurred them, but they haven't been reported. It could be losses we're still trying to adjust. It could be pure estimation. But it's some portion. There's unknown here. And it could be that some insurers over-reserve. So that's increasing their liability. So therefore, all other things constant, lowering their equity. But it's also kind of a safer bet. It's not uncommon for individuals when they look at expenses or estimate expenses, if they are risk averse, it's not uncommon for them to overestimate expenses. You'd rather know at the end of the month you've got an extra $100 than you owe an extra $100. But some insurers do under reserve. Okay, now it could be unplanned, it could be accidental, or it could be planned. So there's estimation there in loss reserves. Now with your unearned premium reserve, this is not quite as acceptable to estimation, really. These are the premiums for which you have not provided full protection over the policy period. So if you write a policy for 1 year, the premium is $365. A good way to look at this, at day 0, when you write that policy, your unearned premium reserve, which is liability, is $365. You have not earned any of that. Day 1, let's say it's $1. Day 2, $2, 3, so on and so forth. Right? We've earned that. So as we earn each dollar, the unearned premium reserve is going to decrease by that same amount. So it's a balancing account. So at the end of the year, we have earned all $365, and our unearned premium reserve has then, for that account, been reduced to 0. Every earned premium dollar, we get to invest. We cannot invest unearned premiums. Why? It'd be a huge moral hazard issue. If I can go out and write policies for all you guys and invest every single dollar, I have nothing to pay out when you do inevitably suffer a loss. Huge moral hazard issue. So insurers have to keep as a liability unearned premium reserves. right? So we understand that moral hazard issue, right? I could just go and write all these policies, take in all the cash and invest it, and then if you guys lose, I have no way to pay. It's a big moral hazard issue. Now, policyholder surplus here is the net of your assets and liabilities. So that's equity from an accounting perspective. That's all we look at here. That's kind of your cushion. So if you do have a bad year, maybe not your fault, not underwriter's fault, not rate makers or actuaries' fault, it's just a bad year, like the farm insurance example we were using earlier. You have a bad year, hopefully you have enough assets you could liquidate. You have this surplus year to pay out. Or it could be you expected actually to lose even more than that. You over-reserved. So you do have that bad year, but it's still not as bad as you expected or you estimated with your loss reserves. So there are options there too. Now, what about on the income side of things? So the two sources of revenue, premiums and investment income. Premiums and investment income. So earned premiums here, already kind of mentioned that. That's that balancing account for the unearned premiums. You can invest these. You can invest earned premiums. We provided protection for that. We've earned it. Common expenses, claims adjustment. Claims payment, so paying losses. And then what I would call kind of pipeline costs or underwriting costs. So how do we measure profit and loss? How do we measure profits and loss for property and casualty insurers? We have a few options here. We're going to build up to an overall measure, an overall ratio. But our first line of defense, kind of get an idea on things, is our loss ratio. Now these are things that I expect you to do in the future. Were this a traditional class, I would say yes, you need to memorize these. But because you're taking these exams online, you can memorize them if you want to, or you can just look at them. Okay. So just, you're curious. So a loss ratio is going to tell us at the basic level kind of our rate making efficiency. Or underwriting, sorry. We do have an underwriting ratio, but this is how much we're actually paying out. So you can think of this as our losses, our total losses here, right? We still have to adjust here and there. But our expected losses, no, this would be our actual losses. So we have an expected loss of, what do we say, $500, but was it really zero or was it really 5,000? Okay. But we have 100 policies or 1,000 policies. So we have our actual kind of payout on just that policy. We haven't included paying actuaries, underwriters, anything. We take that and scale it by the premiums. If this is over 1, we're already in for a bad time. There are no other expenses. And yeah, we have investment income we can think about. But if this is over 1, we haven't even begun to pay our underwriters. So we're already, in hot water here if this is above 1. So this is our loss ratio, our incurred losses, and adjusting those, it may be up, maybe higher, right? Scale by the premiums we write out, right? Why is that a problem if it's above 1? Well, you're paying out more than you're even bringing in, and you still haven't paid the underwriters or adjusted for their time. So what about underwriters? Well, the expense ratio tells us kind of our cost of classification here, right? Because underwriters, what we really want there is a discrimination against bad risk. So not like a social discrimination, not that usual construct that we think of discrimination. Though it can cross over to that. We'll discuss that later. No, we just mean that we're kind of discriminating or providing equity, really, is a better way to look at it, against bad risk. It doesn't have to be individuals. So our expense ratio here is just our underwriting costs or expenses for that period over the premiums. If we combine the loss and the expense ratio, that's going to give us a total picture of our underwriting efficiency or efficacy. So that is our combined ratio. So our combined ratio tells us the kind of full picture of our underwriting profit or loss. So if this is above 1, we're operating at an underwriting loss. So our primary business function is not making us money. That's not uncommon. For the last 3 years, State Farm has not made money underwriting for personal auto policies. They pay out more than they bring in for their auto policies. But they've been in the black. So they've made money. Why? They invested. Also, they write different policies than just personal auto policies, so there's some diversification they can go through there. So what we don't have here is investment. So if this is above 1, bummer. But we have one last line of defense, and really the only line of defense if this is above 1. So our investment ratio is going to be our net investment income scaled by what we can actually invest, which is the earned premiums. Now this could be negative. You can lose money on investments. So if you're underwriting, your overall, if you're underwriting, you're already above 1 there, and this is negative, that's a really bad year. But since this is an investment or an income ratio, we net this from our previous ratio, combined, to get the true bottom line for the firm. So with all these expense ratios, with the exception of the investment income ratio, it's an income ratio. The sum of all these, or these two really, less the investment is our total bottom line, so our overall ratio. If this is above 1, you didn't make any money in any way for this period. Ignoring, we're just looking at keeping everything else constant. So I'll provide you a worksheet to work through a few of these, and you will see some examples like this in your exam. But again, you'll be able to come back and look at this. More important to me is knowing the break points. Really above 1, it's not ideal. And knowing what each of them are telling us. You can do the math. All right, so what about life insurance? What's different than that? All right, we'll go to life insurance and we'll look at balance sheet stuff and then income statements. Well, to remind you, assets here, they're still investments. They might be longer term. The underlying policies are not as risky, so our investment money can be tied up for a longer duration. We could say it's riskier, right? It's tied up for longer, so that's riskier. We expect a higher payout too. Now, liabilities here, we do have policy reserves, but they have to be balanced by an asset equal to that amount. So some bond holdings, real estate. We have to estimate that out as our reserve. And I listed it here again, policyholder surplus is the same, asset less liabilities. So there's nothing new there. Not much different on the income and expense side of things, but just a quick reminder here. So not much different there. When it comes to performance though, we can do ROA or ROE. So we take our net income and either scale it by assets or scale it by equity, which is the surplus. And again, they tend to be less volatile compared to property and liability or property casualty. Now, a few little things here. We'll shortly be done. Rate making. So some of the objectives here, because this is still part of operations, some of the objectives of rate making. We want to keep it balanced. We don't want to charge too much, then we have either no customers or just high-risk customers. Could see a downward spiral. If we don't charge enough, we keep seeing our overall ratios above 1. Underwriting's not great. Our investments aren't able to recoup those losses. We just keep digging ourselves a deeper hole. Rates must not be discriminatory. Now, this is in a more social setting, right? So this means discriminating against protected classes. So for business insurance, or if we're looking at larger, or any firm, really, no, that's not going to hold up. But for individuals, yes. Now, example, in life insurance, you can't cry ageism. Okay? You can't say this life insurance policy is ageist. If you do that, then life insurance will no longer exist, because it is absolutely ageist. Because it's just looking at risk, and the risk of death increases almost directly proportionally with, well, not directly, but it increases with your age. Doesn't mean being old is bad, but all of human history, the risk of death increases the longer you live. With some exceptions at younger ages and risk-taking, but ultimately you can't cry ageism. You can't really cry sexism either. You don't choose how old you are. You don't choose, So they can't be discriminatory. And we'll actually see this at the end of chapter 8 in a little bit different way with credit score ratings. So some insurers use credit scores to kind of set rates or underwrite. But there are some arguments to be had that that could be discriminatory. So we'll look at that later. So basic objectives, make it easy for everyone to understand. We want some stability. We don't want underwriting ratios just, all over the place. We prefer stability. And we'll be responsive and not retroactive. Don't want to move too late. And loss prevention is always a good thing. Now, this here, we already know all this. We're not going to discuss yet gross rate and gross premium. And we already know each of these definitions. So this is more of a quick reminder. Okay, we know the rate, no exposure. We know the pure premium. That's our expected loss. We've already done that. And we know the loading. We did that last week too. So this is more of a reminder slide here. Okay, quick reminder. And gross rate, gross premium, we're not covering that today. All right, so how do we go about setting these rates? Okay, what are some of the ways we could do that? One, it could be on kind of a case-by-case basis. So judgment rating. Each exposure unit, and we could maybe look at it from a client perspective. Each client gets their own tailor-made policy. This is more common, the less common the risk is. So you wouldn't really see judgment rating for renter's insurance, because that's quite common, or homeowners, or personal auto. Maybe for directors and officers insurance, maybe. Class rating, we're to group similar exposures. So maybe it's that, all right, we know this industry sees these particular types of risk and loss exposures. We see that you're coming to us looking for business income insurance. You're in that industry, we'll rate you based on what we consider, that class. Now, merit rating. And within merit, we have these three here. But this is just adjusting class rates based on some new information, some additional information, or some historical information. So a schedule rating is more based on the insurer's discretion. But all right, well, you're in this same, you want that business income insurance, you're in this industry, we kind of put you in that class, but maybe you make some decisions that we think are a little more risky than your cohorts in that industry. Say it's the oil field or something like that, and you just do fracking. You don't drill any other way. So maybe we think that's a little bit riskier. So we might upcharge you. So that'd be a schedule rating. But we don't have any loss data. We don't know if you are actually risky. We just think you might be. We have information, but it's not actual loss data. Experience rating, on the other hand, is when we do have prior losses. So we have previous losses. So you're in a class, but we have your loss exposure, and we'll adjust accordingly. Maybe you're not as risky as we thought. You give us some loss data, and we're like, oh, okay. Your income's more stable than we expected. We'll lower your premium. So experience requires historical loss data or loss experiences. Retrospective will be if I tell you, okay, this is the premium I'm going to charge you. If your losses are higher, I'm going to charge you more at the end of the period. So it's retrospective. If they're lower, I'll reimburse you a bit. So that would be like me saying, I'm not entirely sure. This is where we're going to start. If you're less risky than I thought, then I'll reimburse you. If you're more risky, then you'll agree contractually to pay me for taking on that extra risk at the end of the period. Because think back again, we don't know the full cost of these products. So this is me as the insurer saying, hey, this could help or could hurt you. Neither of us really know. But we'll work on it kind of ex post, so retrospective. Okay? Now for life insurance, essentially what we have is mortality tables. Okay? We know how much the expected value, how much you're going to have to pay out when you do pass away to your beneficiaries for most policies. And we can estimate when you might pass away based on a few factors. Any questions about Chapter 7?